Good morning, everyone. You're all very welcome to another market update here at the Alpha Capital Group. So first things first, obviously highlighting on last week's weekly closures. We'll be looking at that this morning. Of course, we will, of course, be looking at the economic calendar for the next couple of days as well. So looking at price action, looking at the structure within the markets, looking at some of these different asset classes. So this morning, we will be looking at the FX markets, just picking two or three of the primary majors. We've got oil, gold, and of course, the European and US based indices along with the DXY. So just looking at the broader viewpoints in the markets, looking at sentiment, looking at, I suppose, current performance in respect of obviously last week's close and of course in the beginning of this week. So first things first, without further ado, let's open up the economic calendar. So for today's price action, I suppose the big contributor today is really going to be Canadian inflation. Okay, we talked about the US inflation last week and we'll be looking at the effect on the charts shortly. But of course, this week, today, we do have Canadian inflation. Now, of course, if you look at year on year, month on month, we have seen some fairly significant moves in the oil markets. And we have to obviously factor in that in respect of the Canadian economy, oil is a very, very key driver of price stability, of economic and currency performance, but of also in terms of the inflation figures as well. Okay, so current inflation in Canada is looking like it's coming down. So these global increases in interest rates are starting to take effect, and we are starting to see the inflation figures obviously come down. So 6.8% back to 6.4% is really the consensus. So of course, for broadly inflation figures, the less or the weaker the data is, the better it is for the economy, okay? Because that means obviously the cost of goods and services are coming down in respect to a month ago, 2 months ago, 3 months ago, etc. Okay, so that's really going to be the important one today. Of course, we have, if you go into our dashboard and in the analysis tab, you can see previous data as well. So you can see that Canadian inflation way back in July of last year was was in the 8s. Then it went back down to the 7s. Now it's in the 6s, and it's looking to come down a little bit more steeply, which is obviously a good thing. Okay, now tomorrow, if we look at tomorrow, we obviously have tonight into tomorrow morning, 3 a.m., we do have a BOJ interest rate decision. Now, of course, we're not expecting changes in the actual rates set out by the Bank of Japan. But what has become extremely important is the BOJ's stance in terms of the government bonds. Okay, because of course, last time out, they kept the rates flat. They kept the rates at -1 as -0.1%. However, they did have that changing in the cap of JGBs, the 10-year JGBs, and that obviously went from 0.2 to 0.5%. Now, as a direct result, what happened? That was really the start of significant strengthening in the Japanese yen, as we sold off, I think, a modest 300-400 points through that Asia session. So I think you will see volatility tonight. I don't think it's going to be in terms of the interest rates. I do think they're going to try and keep the interest rates as low as possible, but don't be surprised to see another changing of stance in respect of the government bonds. So do keep an eye on that for those who are trading during the Asia session or maybe the back end of the US session close as well. All right. Now, tomorrow morning, we do also have inflation in the UK. Okay, so inflation in the UK is an extremely important thing because, of course, it was one of the only economies to break that 10% threshold for inflation. Now, if you look at the analysis as well, previous data, December's inflation actually came in at 10.7% on the actual. So up until December, the inflation figure was nearly still rising because, of course, November's figure was in the 11s. December's figure did come back into the 10s, but we're looking to see that steeper decline. So the inflation drops that we're seeing in Europe, the inflation drops that we're seeing in the US more broadly over the last, let's say, 3-4 months, we're looking to see can that replicate in the UK as well, because, of course, tomorrow's inflation data in the UK is looking to go from 10.7 back to 10.5%. So, of course, if we're coming in at, let's say, 10.2, 10.1, even if we broke the 9% mark tomorrow morning at 7 a.m. when that data is released, you're going to see a massive influx of price action, of movement in the markets, because, of course, the markets are going to have to price in better than expected inflation levels. Now, don't get me wrong, 10% inflation is still absolutely criminal, and it's an injustice that central banks would allow the inflation rates to go that high within their lagging policies. However, from a data perspective, from a day-to-day perspective, it is important to factor in what's priced into the markets. And of course, if news or if data is better than expected, the markets are going to have to price that in accordingly. So it's just being aware of that situation. Now, again, tomorrow, another inflation print coming out in Europe, obviously with the broader Eurozone, 10.2. The consensus is actually for a 10.1 back to 9.2. So they're expecting nearly a 1% drop in the inflation levels. And that's quite a significant amount from the year-on-year final figures. So just be kind of wary of that. A 1% drop, yeah, it's quite a lot. But don't be surprised if there was a miss on this. Maybe if it was 9.4, 9.5. You see, every other economy is pricing 0.4 to kind of 0.6, 0.7 of a drop. Europe is looking for a bigger drop. So, of course, if that's not delivered on, markets are going to have to price that in accordingly as well. So just be aware of that tomorrow. So between Canadian inflation today, UK inflation tomorrow morning, and European inflation tomorrow morning as well, it's going to be a busy 24 hours. We're going to start to see the markets ramp up a little bit. And that, of course, then brings us into the US session tomorrow. Now, of course, yesterday was Martin Luther King Day in the US, of course, a bank holiday. Today is the first full US trading session where all markets are effectively opening and back to normal volatility, normal volume. So it's important to be aware of that as well. Now, of course, tomorrow with the US data, we have a raft of data out between 1:30 and 3, right? Consistently, we've got PPIs out, we've got Canadian PPIs out, we've got retail sales at 1:30, we've got industrial production, manufacturing production, the NAHB housing market index as well. That's going to be an interesting one to keep an eye on. So we've got a massive amount of smaller data points throughout tomorrow afternoon, leading up into the US session, but broadly after the US session as well at 3 p.m. as well. So worth keeping an eye on the data. I think that's going to be important as well, because these data points will move markets as well, albeit to surprise to some people. So obviously, if you look at US retail sales, it's pricing in weaker than expected retail sales. Of course, that's effectively saying less monetary supply in the economy effectively means more people are spending less in the economy, which of course would mean retail sales is decreasing. So the likes of weaker ISMs, weaker retail sales, weaker productivity, higher unemployment is generally all collectively alluding to the fact of a recessionary idea. Now, of course, a lot of people aren't expecting recessions, even though we've had back-to-back negative quarters in 2022 of economic growth. However, it hasn't been officially confirmed yet, even though in real terms, in the real economy, when you price real goods, products, food, energy, fuel, obviously we're seeing kind of 20, 30, 40, 50, 60% increases year on year. So in real terms, in the real households, in Europe, in the UK, in the US, the recessionary feel is definitely being tackled, being faced head on as we speak. So that's kind of the markets for the next day or so. Of course, tomorrow night as well, we do have Japanese data as well. So that's going to kind of lead into the middle part of the week. And of course, we will be back really on Thursday to kind of look ahead at some of the data on Thursday, because of course, Thursday we have Aussie data during Thursday night or Wednesday night into Thursday morning. We have a raft of data out in Europe as well. And then, of course, we've got more US data on Thursday as well, in terms of EIA, in terms of oil exchanges, stock change, gas change, etc. So that's going to be an interesting one, particularly for those who trade commodities as well. All right. So that's kind of where we are from a midweek market update. If we firstly now kind of look at the DXY, right? So if we look at the DXY, let me just clean up this chart. We can see that the DXY, following last week's CPI figure, has obviously continued to move to the downside. Now, structurally speaking, right, I think this is what's really, really important. If you look at the price action into last week, we've had a very flat, a very stagnant, a fairly sideways moving piece of price action for the better half of last week. Okay, Thursday, we had that snap off the CPI figure, an almost immediate rally back up. Now, of course, we can see very, very clearly that the 4-hour order block or the 1-hour order block here on the DXY was fully mitigated, because we had that very, very sharp snap back to the downside, almost immediate recovery back into the level here at 103.20, and then we had that further decline to create new lows again. So this is the type of movements that tends to happen during high volatile news events. You get the market snapping both directions, and that's really just to kind of take people in and out of the markets. Okay, the algo is obviously taking people in, and then that snap back is obviously taking people out of the market. I think that's something that a lot of retail traders aren't aware of. And I think it is important to be aware of that dynamic, because, of course, behind the scenes, you've got a couple of big institutions pushing prices with higher volume, higher order flow. And that's why it's important to be trading with the banks rather than being trading against them, because of course you will get caught out 9 times out of 10. Now, if we look at the DXY from last week, we've just seen that gradual assimilation to the downside. We've had local highs form here around 102.50 on the DXY, but we're still containing or still creating new structural lows in the DXY. We've made structural lows on Friday morning at 102. We did obviously get that snap back, but we made new lows again Sunday night into Monday morning below 102 for the price action obviously to correct. Now, structurally speaking, we're waiting to see kind of what the reaction is, because since then the price action's returned back up into the short-term order flow liquidity area here around 102.50, and I think that becomes the area here. Of course, if we are to get a break above kind of 102.60, take out these local highs, then you're really looking for an assimilation back into dollar strength and back up for a probable return back up into this region up here. However, at this moment in time, market order flow, market liquidity is still remaining quite consolidated in the FX pairs, and we'll look at that now in a second when we look at euro, cable, and dollar yen to a lesser degree. So really kind of looking to see kind of what the next cause of effect is here between kind of 102.20 and 102.50 on the DXY, because of course, since really kind of Monday morning or late Monday morning into Tuesday, this morning, we're just effectively seeing the price action move sideways, and it's of course being aware of that as well. Okay, now when we look at Euro USD, right? Firstly speaking, when we look at Euro USD, what is happening on the broader perspective? Well, the order flow is still obviously ticking higher, right? And that's alluding to that weaker DXY on the broader perspective. We talked about that break last Thursday, that continued kind of evolution to the downside, sub 102. And of course, the higher time frame movements is really fueling that euro dollar rise to continue to the upside. Now, of course, last week we did manage to break through 108. Friday we got a closure above 108. However, in the last day or so, markets is still consolidating around 108. Now, there's two things really to look out for here. Is if the price action gets a daily closure back above 108, that's symbolically saying, well, the likelihood is now DXY is going to continue pushing higher, and therefore Euro USD is now going to be in a little bit of a correctional state, because of course when the DXY is bullish, Euro dollar is bearish, cable is technically bearish, dollar yen is bullish. Okay, why is that? Because of course when you've got a stronger dollar, you have a stronger USD Indies currency quotes. So obviously the base euro obviously being weaker, cable, GBP obviously being weaker, and USD, because it's the base, is obviously looking to push higher. So it's simple understanding of how these markets react, whether it's dollar strength, whether it's dollar weakness, whether it's index outperformance, whether it's index weakness, and putting these into very, very simple terms. One of the easiest things traders can look at in obviously the financial markets. Now, as we said, kind of 108 here is a really, really structural important level here on the euro dollar. Of course, if we do get that break of 108, the likelihood is we're probably going to continue moving lower back into some of these regions here between probably 106 and 107. Now, of course, when you look at the price action structurally speaking over the last week, very, very significant moves on the euro dollar to the upside. Why is that? Because of course the DXY is rolled over. Now, if we do get that little bit of a bat in DXY strength, let's say back up to 103, 103.20, maybe even 103.40, back up into this grey shaded area, well, then that's going to allow for euro dollar really to be more correctional in terms of the mindset. Now, of course, at this minute in time, Euro USD is trading off of that 118.15 level. So a break of that kind of 118, this kind of yellow area here, 107.90 to 108 level, I think is really going to bring sellers back into the fold. And of course, all you literally have to do is to identify the pullback or retracement is use the fibs, because the fibs, of course, will guide us into this area down here around 106. Okay, so that's obviously very, very simple play, but obviously keeping things simple. We're not overcomplicating things. We're reading the price action in accordance to what the market is telling us, and we're having a structured output in the back end. But as we speak at the minute, still holding that 108 handle fairly clearly on euro dollar. Now, similarly with cable, if we look at cable, broadly speaking, what's happening with cable? Well, previously in November and December, we had that bullish trend, and I'm leaving these blue lines just as an identifier of the higher highs, higher low play that was playing out. Very, very clear order flow. Price action was corrective, pulled back in. Obviously, a little bit of a weakness into the end of the year in the pound, and that was visible across the board. And we're even seeing that now currently at the moment in time. But of course, over the last week or so, since really the 6th of January since the NFP, and of course since last Thursday's CPI, which we're going to look at now in a second here in cable. It has kind of ticked higher. Now, of course, we would like to see the price action kind of get back up into this 123.50, 124 level, because of course on the daily, that's taking out this liquidity area, because of course we have very, very clear bullish trend, kind of break of internal price action here on the daily. 1, 2 been taken out, flag back up, take the last liquidity, reject the daily order block, and start to see that kind of erode somewhat. However, we're still in that development stage as of yet, because of course, when we look at cable on the 1 hour, when we look at it on the 4 hour, we obviously had that run up off the back of NFP last Thursday, off the back of CPI, massive run up, taking highs, massive run back down, rejecting these subtle lows here at the bottom of this range, and then we simply grind higher back up into the local area. Now, of course, since then, what happened on Friday, Thursday? Well, of course, we had local highs here at 122.40, and you can kind of see that playing out pretty clearly. If we just draw the horizontal ray across, you can kind of see that playing out pretty clearly, local highs. And then, of course, what happens then? Well, we get that break. We get that closure to new highs up as far as 122.80. And then the markets come all the way back down, taking this bullish impulse out in terms of the liquidity, excuse me, and comes back to this 121.80, 122 levels where markets are currently sitting at. Now, for those who are trading short term, you can even see it this morning. What's happened this morning? Fairly clear consolidation. We take structured lows or try to instigate lows into the markets. Market rallies all the way back up to 122.30. So we've taken lows this morning, we've taken highs this morning on the range, we're pulling back down into the zone. So it's really a case of now, again, as we said, this area here around 121.80, 121.90. If this holds up, we might see a little bit of a filter of strength in today again, but that's on the proviso of a weaker dollar. So of course, if that DXY picks up strength and we start to see these short-term lows here at 121.70 being broken and more detailed down here at 121.50, then you're probably going to see the cable slide deeper into obviously the better half of the European session today, and then obviously into US-based session as well, where we've got a lot of data. So of course, we're seeing this area here, but we've also got all of this unmitigated price action, right? We've a very, very clear buy side and balance in the markets, moving very, very sharply in one direction. So naturally enough, over time, this order flow, this liquidity in the markets is going to get taken out eventually. But firstly, a break of 121.50 is imperative, and then looking to see, can we actually take out those structured lows at 121, and that will really allow that deeper correctional pullback. But of course, again, for that to happen, that's on the proviso of, as we said, a stronger DXY, and of course, seeing the price action ultimately take out those levels that's being witnessed in the markets as well. All right. And that's really, really, really important at this moment in time. Okay. So that's kind of where we are there on the FX side, broadly speaking. Markets very, very turbulent, very, very back and forth because of obviously the consolidation within the region. Now, dollar yen is the next one we're going to look at here very, very quickly. And dollar yen, higher time frame, very, very clear bearish order flow. Structured trend is playing out beautifully, right? We get the top, we get the break, price action comes back up, very secondary degree of sell side imbalance, takes out all of this bullish liquidity here from September and October, taken out of the markets. Then we start to see the order flow playing out. Lower highs, structured lows, lower highs, structured lows, lower highs playing out. On the daily, pinpoint perfect price action. We've made new structural lows again. It looks like the DXY is getting another potential correction, or the dollar, should I say, is getting another potential correction here on dollar yen, and we could very much easily see a move back up into maybe 132. Now, that's a higher time frame approach. If we look at the shorter time frame analysis, well, we've got, as we said here, we've got order block here, 4-hour order blocks here between 136. Just underneath 137 and 138. Obviously, clear areas of liquidity. We've got another one over here as well from November. Then, of course, we had that massive run up or massive downturn in terms of dollar yen movement last week. And of course, CPI was the catalyst for the move. Now we've got that correction, dead cat bounce recovery, new lows again, another break of structure, and price action has got a double mitigation off this liquidity level here between 134, 134.50. And you'll even notice on Friday, we actually did temporarily break through the structured high. So taking wicks, taking liquidity out of the market, stop hunting, only to very, very quickly reverse. And within the 2 4-hour following candles between this candle and the second one, we've taken 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 previous 4-hour candles nearly out of the market. So that's alluding to the fact that heavy selling can break away very, very sharply from these regions. Then we'd obviously a bit of a pause into the weekend, and then we had that follow through of further dollar yen weakness, obviously last week, Thursday, Friday, into obviously this weekend. We were obviously seeing a little bit of a bottom, and obviously that migration of filtering from dollar weakness last week into more stationary movements today, obviously yesterday, is starting to give the markets a little bit more even order flow. And of course, we're seeing can we break back above 129. I think if we can take above 129, 121, 129.30, the likelihood is you're probably going to get another correction. And it's really a case of how deep is this correction going to come? Because of course, on the daily, you've got order flow here at 132, which again is symbolically saying there's still another potential 300-point upside pullback. So when the downside moves are quick and fierce, you tend to see the bullish moves just as fierce. Of course, here is an example. Very, very clear downside selling, very, very clear correction, very, very clear downside selling. Are we going to get those moves back up? Well, at this moment in time, it looks like that's going to happen as well. All right. So obviously, with dollar strength, it obviously means weaker euro, weaker pound, particularly against the USD. Gold prices are obviously selling off. So what are we seeing structurally speaking on gold? Well, higher time frames, very, very clear order flow in the last number of weeks. We've tried to kind of clean up this market out a little bit. Continually new higher highs, higher lows been playing out. Obviously, this weekly area here between 45 and 75 daily weekly zone on the daily, weekly time frames is obviously yet to be fully mitigated, but the price action is getting there, right? It's creating highs, it's creating lows, it's getting a new high, it's getting a pullback. Now, when we isolate the price action over the last week or so in gold, obviously we had that key break of 1810 we talked about last week, and then we had an area up here around 1875 where we halted initially, but then we had the break, we had the pullback. Then of course we had CPI last Thursday, very, very clear run up again. Price action came back into the range, taking liquidity. And then, of course, on Friday, we had another run up. We had structured highs been broken. We back into the short-term order block here on the 1 hour at 1896 and rallied all the way up from 1896 to 1928, where the markets have since eroded. Now, what's happening since then? Well, we're starting to get that next correctional bias, next correctional move. And it's really a case of, well, how does the market react really in this region now? Because, of course, we have taken structured lows initially at 1910. We got structured short-term highs at 1920. We've broken through those lows this morning, and the markets is in a correctional stream to the downside, most likely back into this 1890, 1899 level here, but don't be surprised to maybe see a falter at 1900. So really 1900 to 1890 is really the area to watch. And of course, if we do break through this short-term level, really then you're looking for a deeper move to clean up all of this imbalance from Thursday afternoon, Thursday night into Friday, and of course into the beginning of this week, where the markets will probably unload back into maybe 1870, 1875 as a more likely play. So gold obviously then moving lower as well. So of course that's factoring into the potential of dollar strength. Now, of course, if we see the DXY erode and this kind of short-term strength we're seeing this morning erode, not break through 102.50, and then of course you're more likely to see this level hold up, and that becomes the next short-term higher high into higher low within this kind of 4-hour daily trend. And of course, the potential then to really kind of kick on into some of these upper levels. So really kind of watching the bullish trend as things play out at the moment. Now, moving across the oil, right? What have we seen on US oil WTI? Well, we had the 4-hour order block here at 81.45 being fully rejected after we hit the daily lows from last year. We got that correctional movement all the way back up, as we said, filling out. So all of this sell side imbalance in December was mitigated really in the latter end of December, early part of January, being fully mitigated. Then we sold off again back into the structural region 73 before the price action has now started to turn on its heels back up into this region. So really short term is how does the markets react here between 81, 81.50. Bullish price action is still playing out. Does that mean we're not going to break through? Not at all. But we are starting to see a correctional movement because, of course, lower lows, lower highs, lower lows, lower highs, failed lower low, right? So really we're looking to see now, can the price action get a break of structure? Can we get a break of this structured area of liquidity, structured area of order flow, and really breaking through? And of course, your catalyst for that is a break of 83. And if we get above 83, that's really the tide turning here on oil, because of course, we've gone from bullish trend into a top, into bearish correctional movement, all the way back to the daily order block from December 2021, which has been mitigated perfectly. Bearish order flow, lower lows, lower highs. And then, of course, if we get that break, that's effectively a new short-term high, which is taking out this structure, which is effectively potentially giving us a change in the guard, a change in the sentiment for potential rally in oil prices, let's say from back and through from the high 70s, low 80s, maybe back up into these high 80s, low 90s as well. So it's important to be aware of that. Now, as we turn to the indices, what are we seeing in the indices? Well, of course, the weaker dollar over the last week or so, let's say up until this morning, let's say, has allowed the S&Ps to continue churning higher. Now, of course, if we take ourselves back a second, because of course we had CPI, we've obviously NFP, then we'd obviously CPI to factor out over the last, let's say, week and a half or 2 weeks or so, right? We've structured from the Friday the 6th of January to now, which is about 10 trading days or less. Now, if we go back to December, right, this was the December CPI run-up. A 4-hour order block from September was fully mitigated perfectly. We took highs. And then, of course, the ECB, the Fed, the Bank of England was the catalyst, was the narrative, quote unquote, for us to break the structure out of this range. Now, what's happened since then? We had a year-end consolidation in the markets. So we've taken highs, we've taken the lows structured of this region into year-end, into consolidation, and now the markets is flagging all the way back up into this order block here, all into this kind of 4,000, 4,050 level. And that's kind of what we've been looking at for the last, let's say, week, 2 weeks, is to see, could the markets get back up? So we've broken away. We've obviously consolidated. We're now getting the bullish order flow, and we're looking to see if there's any sort of reaction from this region. So, of course, the bullish nuances within the S&P has been brought about by negative DXY. But of course, if we see that flip of the coin and we start to see that DXY strength filter through, really then we're going to be looking for that filtration of sentiment out of positive indices into more stagnation and probably a potential rollover. But at this moment in time, we're not kind of fully mitigating yet the 4-hour structure. If you go down to a 1-hour chart as well, you can also see up here at 4038. So 4015 to 4040 is really the area to keep an eye out on, because of course at this moment on the indices, if we isolate, let's say, just the 1-hour charts and the price action from, let's say, last Monday, last Tuesday up to present day, we are still creating higher highs, higher lows. All right, so higher highs, higher lows, higher highs, equal higher lows here, new higher highs again yesterday. Markets are obviously consolidating. So at this moment in time, we're still seeing indice progression to the upside, but we're really looking for that kind of change in dollar weakness to dollar strength, indice strength to indice weakness, allowing that filtration of shift, filtrational shift in the markets to then say, well, look, we're now changing our bias accordingly because of market sentiment. Now, Nasdaq, very, very similar formation. What are we seeing on the Nasdaq? Well, higher time frame approach again, back and forth. So this was obviously the December CPI, very, very deep runoff all the way back into this liquidity area down here, rejected it, held it to the T perfectly, accumulated then into year end, and then of course had that massive break. And I did say last week, once we break through 11.3, you're really then looking for that filtrational push up, back up into this order block, back up into 11.8. Now it's taken a while for it to kind of gradually grind higher, but that's because the Nasdaq, when the sentiment in the markets is clear and is going well, the Nasdaq outperforms. But when the sentiment is mixed, when there's a lot of external circumstances that take into place, the Nasdaq tends to be a laggard, right? And why is that? Well, it's because of the volatility associated with tech stocks in the Nasdaq. Okay, and that's really, really, really important for traders to obviously be aware of. Now, of course, the S&Ps is up much higher in relevance, and even at the Dow Jones, if you look at the Dow Jones is actually trading at or even above this 4-hour zone. So although the Nasdaq and the S&Ps is yet to get those December CPI levels where we were before the Fed sell-off on Wednesday, the 14th of December, the Dow Jones is there. So it's obviously clear to see how the Dow Jones is outperforming against the Nasdaq, against the S&Ps when you look at it in real time. All right. So that kind of level is unchanged. I'm still waiting to see if there's any sort of reaction here on the S&Ps. Similarly, again, in NASDAQ, although it probably mightn't get there to 11.8, I'd rather be patient, be clear, have a patience within your trading plan, have a clarity within your structure as well, what you're looking for, and it gives you more to look out for in terms of risk reward as well. Now, Dow Jones has come back up into this 4-hour order block here, 34.1 on the daily as well. If you go daily, it's actually trying to break through, but we've got a daily run-up zone here in grey between 34.4 and kind of 34.8. We had the initial daily order block rejection here at 34.875. So that's really kind of one to watch, because of course very, very clear rejection off the daily order block, takes the liquidity out of the markets, rolls over, breaks structure, flags back up all the way up into this region. So really now, I suppose the 4-hour structure, if you wanted to bring in the 1-hour charts as well, is really kind of worth kind of looking at, because of course 1 hour the liquidity, if we just go to the full screen for a second, you can see here as well, markets are becoming fairly stagnant here between 34.3 and 34.400. So the logical scenario is, well, if we do break through 34.3, 34.400 level, you're probably going to see the Dow Jones probably continue higher. 700-800 becomes a very, very likely scenario. But at this moment in time, very, very correctional, in line with what we saw in the S&Ps and the Nasdaq as well. Now, last but not least, let's look at Europe, right? European indices have been on a rampage since the beginning of the year. We talked about it last week. Just complete and utter buy-side imbalance, like just completely creating havoc for those who are trying to sell the markets. Now, of course, DAX structured highs into year end was obviously around 14.6. That was taken out very, very quickly. Then, of course, if we go left to look at this key level of price action here between 14.9 and 15,000, that was even taken out. Now, the next area really is up here around 15,350, 15,400, because, of course, that was a selling liquidity area before we actually got that final break of this supply and demand zone. Because of course, what happened, we broke through, and then we had that massive runoff this time last year, when we went from 15,500 all the way back to 12,500. So there was a 3,000 point drop last January and February. Now, really, we're looking to see if there's any sort of reaction. Now, at this moment in time, you're midpoint, you're above 15,000 comfortably. You're kind of off that 15,400. So really, you're looking at the internal structure, because of course, the price action on the 4 hour, it's just continued to go higher. Now, at this moment in time, we're still creating higher highs, higher lows, right? So we've got a higher high yesterday, higher low on Friday. Sorry, should I say higher high yesterday into Sunday night into Monday. Now, yesterday evening into this morning, we have seen that pull back to 15,000. So really, you're looking for, if there's going to be a shift in sentiment in terms of this bullish trend in the DAX, in the FTSE, in the Euro Stoxx, this bullish trend needs to be taken out. And for that, you need to see a break of structured lows, right? For me, I think you're logically looking for the probability is a break of 15,000. If we can break back under 15,000, that's creating structured bearish order flow, because of course it's taking out this internal structure here, and it's probably going to take this internal structure here. Now, at that point, you've got a new low being created. You've got a new structural low being created. Then you're really looking for that final flush of liquidity, take out your tops, reject, create your lower high. And that's basically giving you a higher time frame shift, change in sentiment. So that's how you should be looking at higher time frame changes in the order flow. Now, when we look at the 1 hour charts structurally, or even to lower time frames, again, bullish order flow is still playing out. So higher highs, higher lows, higher highs, higher lows, higher highs, back into this area. And of course, on the 1 hour chart, we're still holding this area here between 15,040 and 15,080, right? So this 40-point range is still holding, structurally speaking. The higher time frame supply and demand level is also holding, because of course, what happened on Thursday, we broke through, we come back down, we retested, we rejected, and obviously price action at this moment is affirming its viewpoint that it's holding above 15,000. So that's why I brought in that 15,000 level, because that's effectively saying, well, we're taking out the order flow, we're taking out the kind of the structured highs from the tail end of last week, we're getting a new structured order flow, then it's a case of that final flush liquidity. Now, at this moment in time, none of that is yet to take place. So it's only a hypothesis, it's only an idea. We're looking to get the price action to give us clearer directional bias, and then we can obviously try and place or get into the markets around that. Now, similarly, again, in the Euro Stoxx, very, very similar movement in the Euro Stoxx. I took out this 4050 level very, very clearly. Again, similar to kind of what we had in the DAX, 4,200 is kind of really the important level. 4,200, 42.25, 30 is really kind of the important level here that a lot of people are reacting to. Now, when we look at the 4 hour chart, it's almost identical to the DAX, because of course we took out the highs from the early parts of December. Very, very clear 4 hour rally, very, very clear bullish order flow. Just really kind of continue to move higher. So naturally enough, you're looking for internal breaks of the higher order flow. Firstly, you're looking for that cyclical correction, secondary, and then you're looking for that final flush liquidity, mitigate the order blocks on the buy side, take that one final move, and then you can start to see a potential shift in sentiment. But until that happens, it's really just a case of spotting the order flow on the lower time frames, because of course, similar to the DAX, order blocks here at 41.25 up as high as kind of 41.40-ish is really the kind of the important area. So until we start taking a lot of these kind of short-term higher lows out, then you're going to kind of remain with the bullish trend for the minute. All right. So same again with the FTSE. Massive run up, right? This is huge. Like, did I see this coming in January or December? No. But again, this is how interesting the markets can be. They won't always do what you think it's going to do, and that's where the idea of risk management and risk reward is so important. So when things don't go your way, or the maybe a degree of, let's say this is a 25% probability, if that 25% probability actually happens, how do you prepare for that? How do you plan for that? And that's why the risk, the psychology, the discipline is obviously so important in the background. Now, 7,700 was taken out very, very clearly. We talked about it last week, that daily break, that daily retest. We even said last week in the call, the likelihood is that this is probably going to go higher. 7,800 was the likely play, 7,900, which was all-time highs from 2018 wicks. Now, you can also see here, if you look at the weekly closes, 78.15 is the weekly close from 2018 May, which was obviously kind of in the midst of all the COVID, or not COVID, all the of Brexit, should I say. So sorry about that. Since then, obviously in the last few days, we have seen obviously higher order flow, obviously continue to shake out. So kind of like what we're seeing in the DAX, Euro Stoxx, higher highs, higher lows. But we're starting to see a little bit of accumulation now. So if we look at the 1 hour chart now, we're starting to see stagnation. So we're starting to see obviously bullish order flow, higher highs, higher lows, higher highs, equal lows here, failed to break through the structured highs. So obviously if we can break through this kind of consolidation structure here, that is markets potentially giving us something to work with. Now, in my opinion, when you have accumulation like this, looking to see, can we obviously get a very, very clear downside break? And for me, the downside break really just isn't this short-term yellow area here at 78.50, but more likely kind of down through 7,800. If we could get a break of 7,800, that's really the market saying, well, we've gone from bullish order flow, we've started to accumulate, we've had kind of a sideways moving price action, we've tried to break higher, creating this kind of short-term lower high or wick rejection from the highs. We've broken through that weekly level at 7,800, and then you're really looking for that final liquidity move back up into the zone, take the last liquidity, and then start selling off. So structurally like that is kind of what the move we're kind of looking for. So obviously whether that plays out, obviously takes time to develop. It takes time for structure to develop, unless you're kind of scalping, unless you're in and out in the markets in line with your strategy. If you're looking at kind of the broader perspectives, it takes time for structures to develop. It won't all develop in a 4 hour block of price action or a 6 hour block of price action. Sometimes it could take days. Okay. And that's where the patience and the discipline also factors really, really prevalently into the trading plan as well. All right. So that's hopefully a useful market update for everyone this morning. Going through kind of some of the primary FX pairs. We've looked at the DXY, we've looked at gold, oil, and of course we've looked at both the US and the European based indices as well. So tomorrow, of course, we will be looking at euro and pound specifically, and just to see kind of what the reaction is after those inflation prints. So we'll be looking at the markets broadly, and then of course gauging into the US session open tomorrow. So still plenty of opportunities to come this week. I think patience is really, really important. Please, for traders, mind your risk. I think risk management and discipline is so important. Your daily drawdowns are there for a reason. 3% or 2% or whatever it is, excuse me, that you're utilizing in your plan. Please be vigilant and obviously stick to that as well. All right. Have a great week, everyone. Take care.